Let's turn back now to shares of Disney. They are certainly one of the highlights of the morning, up over 10%. This on the back of what were stronger earnings on both the top and the bottom line. Also, perhaps a somewhat surprising uptick in the number of streaming subscribers quarter to quarter. Disney CFO joins us exclusively. We'll talk about these numbers and, of course, the outlook. He is Hugh Johnston. Good to have you this morning, Hugh. I want to start off on the outlook itself because you spoke in very positive terms on the conference call in terms of even 2026 and your confidence. And I just wonder, given your guidance and obviously the quarter you just reported, but the overarching economy, Steve Leisman just talking about it, and worry still about the consumer, what is underlying the confidence that you guys can meet these higher expectations?
Yeah, good morning, David, and great to be with you from Abu Dhabi, the home of the next great theme park for the Walt Disney Company. Couldn't be happier to be with you all to talk about our performance. In terms of the outlook, obviously, we tend to be more on the conservative side when we guide. We don't like to miss for all the obvious reasons. What gives us the confidence is what we see in our own data right now. In particular, with our parks, bookings are up for Q3 of 4%, and that's with about 80% in. And Q4 up about 7%, and that's with about 55 or 60% in. On top of that, we're seeing great results with the streaming service, all of the content that we're adding, and obviously we're quite optimistic about ESPN flagship coming onto the streaming service as well. So those two variables are really driving a lot of what we're seeing in our own data, which tells us we can make this guide and make it comfortable.
Yeah, I want to talk direct to consumer and ESPN, but let me just come back to parks and experiences. I mean, given the economic tumult, so to speak, are you surprised the consumer is as resilient as they seem to be right now?
Well, it's interesting. To me, there's something of a bifurcation that you see. The consumer sentiment data is quite negative, but as we look at the stratified data on consumer spending, upper and middle income level spending is actually holding up quite well broadly. So from that perspective, we do feel good that we've got outside validation. And then combine it with our inside validation in terms of bookings, we certainly feel positively about it. I think in many ways what it comes down to is the consumer is prioritizing more, and they like what the Walt Disney Company is offering, so they're willing to pay the price for the value that we're delivering.
Yeah. Speaking of value delivering, direct to consumer, as I mentioned and you referenced briefly, strong, up 1.4 million subscribers quarter to quarter were added, and obviously profitability up substantially. What does that look like in terms of scaling that business and the EBITDA performance that you can conceivably get, given that scale, with, I assume, costs sort of staying where they are, Hugh?
Yeah, they largely are. We'll continue to invest, obviously, in technology to make the product better and better, particularly around recommendation engines and making the product easier and more effective to drive engagement and to lower churn. But in other areas like G&A and marketing, we certainly have the opportunity to continue to control costs. I think at the end of the day, that product is delivering so much value to consumers that they are willing to pay. And in fact, over time, I think they'll be willing to pay more for it. So we're certainly very optimistic, in not just the near term in terms of the subs, but for this to be a growth business for the Walt Disney Company for a long, long time to come.
Yeah, well, all right. You mentioned over time they'll be willing to pay more. You have already raised price. I mean, I can go back to that day, of course, where you guys announced that you weren't with the company, but I was with Bob at the $6.99, I remember. We're far above that. Are you indicating that your expectation that there's more price elasticity in there for you and you can charge more fairly soon for the service?
Yeah, I do think so. I don't know about fairly soon, but I think we'll probably be in a steady pattern of increasing prices on that product. And the reason is quite simple. If you think back to what people used to pay for the cable bundle, it was substantially more than this per month. And at the same time, I'd argue this gives you a lot more value because it allows you to control what you watch. It allows you to control when you watch it. It gives you content that you wouldn't have necessarily had access to at the moment that you wanted to have access to it. So I think both the value is really strong, and the price is still a good bargain. Obviously, when these products were introduced, everyone was pricing them in a way to drive adoption as quickly as they could. But now that we're north of 180 million subscribers, we certainly feel good about the fact that we have lots more subscribers to add, but can do so by adding content rather than by necessarily holding prices down.
Yeah.